Wednesday, January the 18th, mid-month already. How quickly the year is going already. I'm delighted to be joined by three of our regular analysts and commentators: Mark Ostwald, Chief Economist and Global Strategist at ADM Investor Services International; Mike McGlone, Senior Commodities Strategist at Bloomberg Intelligence; and Victor Yang, Senior Editor at JLC Network Technology. Thanks so much, gentlemen, for joining us this morning. Mark, can I start with you? Let's all eyes this week, at least a lot of eyes on the World Economic Forum that's taking place in Davos, apparently with delegate tickets up at $250,000 for delegate passes this year, which have quadrupled. Apparently, that's what was reported yesterday. A lot of people still attending. The vibe that we're getting from the commentary there, at least so far, is quite optimistic, given the doom and gloom that we were talking about throughout last year. So, is it wishful thinking, or what's the outlook that most businesses are taking who are attending Davos, and politicians for that matter?
Well, I mean, Davos's relevance in itself, I think, is limited, but this sort of general shift to much less gloom and doom relative to the fourth quarter has been quite marked. It's been there since the beginning of the year. There were some nascent signs at the end of last year, as a lot of the surveys were not coming in as gloomy or improving, if still weak. So we're in a, I think someone termed the phrase slow session, a slow recession. And that's where we really are at. When we're looking at the comments from Chancellor Scholz of Germany yesterday, he was basically saying, I'm confident we're going to avoid recession. So I think we need to be a little bit careful here. Clearly, the move in China, which obviously Victor will address in a moment, to roll back zero COVID has given a lot of, imparted a lot of optimism there. Whether it proves justified is another question. A lot of it is also related to the fact that we've had this unseasonably warm weather after that cold snap. But we're just about to go into a deep freeze. It's very cold in Europe, and it's going to get worse over the next 2 weeks. So it's going to be basically the same as last year, to my way of thinking. A lot of volatility around, things dictating things which people weren't used to. I mean, we are going to be still highly sensitive to the weather, to wind patterns in Europe, and obviously to the news, what happens in China and what happens in the US.
Okay, well, I mean, I'll go to Victor in a minute, but Mike, just to go to you on that sort of optimism feeling, if you like, for the markets. I mean, we've seen the equity markets for the last month sort of recover and go into sort of positive territory again. And again, we started the year with oil as volatile as ever, $10 moves within a week or 2 weeks already. Is that just based on the China optimism, or is it, do you think, a longer term forecast for the year ahead?
I think the China optimism for crude oil and energy prices to rally is way overdone. It's completely consensus. It should be priced in. And if you're that bullish, you should be buying crude oil further out in the curve 2-3 years at a pretty significant discount still, because there's still backwardation there. And I think what we're seeing is normal human nature, optimism for the new year. And the number one hammer in this room is every central bank on the planet, except for two major, China and Russia, tightening, the Federal Reserve still tightening, and that means lower asset prices, and it definitely means lower risk assets, and it definitely means lower crude oil. We're heading to a global recession, and we still have another 60 basis points priced in for the Fed to tighten this year. So I fully expect all risk assets to continue that trend lower. This is just the beginning of the year hopium. You're supposed to be a rational trader and never fight the Fed. And people are still saying that, but that's a lot of sell-side analysts. It's great for human nature to say, but from a realistic market management standpoint, the Fed has never tightened when both the PMI, manufacturing and services indices were in contraction. They are in contraction in the US, and the Fed is still tightening. We have the Bloomberg Global Economics GDP forecast. It's running at zero for global GDP. And we have the most inverted curve on a global basis and US ever. You just don't mess with that when you're a money manager. You sell rallies in risk assets. And I think that's what's going to happen. And you buy bonds and gold. I think this rally in copper is a little bit overdone in the short term. And in the big picture, let's just remember we have significant contraction of global GDP and we have central banks still tightening. And it's not that complicated. You're supposed to be very careful when you get bounces in markets in that environment.
Okay, but you mentioned that we're going to have a global recession, just to stay with you, Mike, for a minute. But the US, let's put Europe aside, it's looking better than it was expected for now. But a lot of people are saying, well, we're not going to see a full-blown recession in the US. You know, what is behind that? I mean, is that because they think that if we nearly get there, that monetary policy will ease off, essentially?
So there's a lot of that is exactly, well, that's what needs to happen. Typically, the commodity markets, Bloomberg Commodity Index bottoms about a year and a half after the first Federal Reserve ease. We're still tightening. And we've just had the hardest tightening in a global basis and a US basis in the shortest period of time ever. To expect a soft landing in that environment is just kind of irrational. And then also we have things like the classic biggest pump in risk assets in ever from this massive liquidity pump that's dumping at the greatest pace ever. You just look at the US housing market, it's collapsing. Look at the Chinese housing market, it's collapsing. These are early days. Maybe it's a little bit later in China, but that's just the facts of what's happening. In that environment, you need to have a pretty significant period of easing, massive liquidity pumping into the system. The key thing to point out is liquidity is being pulled from the entire system. It's just a simple fact of risk assets. You don't want to be long. Don't fight the Fed. And the point I like to make is all these markets are just tilting downward. I'm just pointing at a global GDP track. You just look at the latest estimates from the World Bank. US governments have to do something is what they said. And they're still tightening. So this is couple years from now, we might get a bottom in the stock market and commodities based on normal cycles. This is not a normal cycle. This is most extreme event in history. The key point is the liquidity is being pulled from the market still. So good luck with that one. But good luck. Just look at the
and it is still being pulled because there's still a lot of liquidity there, isn't there? And that's why we're probably seeing some support still. Victor, welcome again. Good morning from China. Making all the headlines again and continuing to do so in many ways. Let's get your outlook now that the new year has started. Official GDP figures have been released for last year of 3%, yes, which is more or less what people were estimating. Let's look at the year ahead. All this optimism, the optimists that are basing their predictions on China, are they right to do so? How soon are we going to really see that filter into GDP figures in the Chinese economy?
Well, we are expected to see some recovery already in the first quarter. As you may know, actually China saw peak infection in December, and people gradually resumed their normal life in January. And the Spring Festival travel rush started on January the 7th, 40-day travel rush. And the Ministry of Transport expected about 2.1 billion passenger trips to be made during this Spring Festival travel rush. Double on year, almost double, about 99% up from last year. So we are seeing increasing travel and people are getting back to normal gradually. And we are going to see some recovery in the January in the first quarter in the GDP too.
Okay, and I mean, what about in terms of, you know, crude oil demand and imports into the country? China still has very good stocks in place and is quite well buffered in that sense. We've had, you know, lower oil prices recently. What is the outlook for where it's going to go in terms of resuming a significant portion of crude imports, if at all, in the second quarter as we move on into the year?
Yes, in the first month, we are still seeing quite large volumes, say about 11 million barrels per day, probably in January, because China issued large quotas in the last quarter of last year, encouraging independents to boost their imports when state-owned companies hike their exports. And you may know China actually boost its quotas on the first batch of 2023 export quotas on oil products very sharply by 46% on a year-on-year comparison. So if necessary, it will encourage Chinese oil companies to increase exports to give the economy a bigger boost. So it might slow down the industry upgrade this year too, if necessary. So this would boost the country's crude oil demand to some degree. Yes.
Okay, Mark, let's go to that, talk a little bit about that, but from the European perspective. So China, if it's boosting its products production and exports into the region, let's talk about products in Europe. Of course, we've got this Russian product ban coming up very soon. Everyone's been saying that's going to have a much bigger impact than the crude ban had, or the price cap, etc. You know, let's talk a bit about that, expectations for that. How much is that going to impact, in your opinion, and how soon will that impact product prices? And secondly, you know, are we beginning to at least see some impact from sanctions on Russian crude filter through to its production and to its exports ultimately?
Well, ultimately, all these sanctions basically are a great displacement game. The key point with Europe always goes back to the same one. It is geared totally to survive, mostly in terms of supply, on oil and gas and indeed oil product from Russia. So there is going to be an impact. What some of the European countries are doing really beggars belief, because basically at the end of the day, some of the crude, some of the product which is now being imported from the Middle East, is basically stuff which has gone out of Russia down to the Middle East and coming back to Europe. One only has to think about what that means in cost terms, because that's obviously a lot more expensive than coming down a pipeline or via a tanker of some description. So it doesn't actually bode well. And unlike with the gas, and even with gas, you know, all these LNG installations which are being made in Germany, they are costing double what the Germans were originally anticipating. So I think the biggest problem that Europe has is it is still vulnerable to a cold snap. It is hugely reliant on oil product, particularly diesel from Russia. It will get it, but at what price? And I think that is basically going to be the dampening impact that's likely to happen for a lot of European countries. And yes, if we look at gas, there's definitely been some adjustment in terms of being more economic, a better use of product. But I think, in terms of freight is freight. You can't actually make a truck or anything else, run slightly better. So it's going to have a dampening effect, to my way of thinking.
Yeah, I mean, Mike, you're pretty bearish on the outlook for the year generally, but on the gas question and prices, global gas prices, I mean, those have softened big time in the last few months because of the warm winter, et cetera, and people economizing on their consumption and industries as well in Europe. But, are we going to see like a 300% spike again, possibly this year, like we did in the first quarter or so of last year? Is there a danger of that, do you think, given your views on recession outlook?
There's always the potential, but we need to remember what happened last year was a historical event, and it's very unlikely to be repeated in most of our lifetimes, because now it's past, we're all prepared for it. That spike we saw in European natural gas was because of the war. Reminds me very much of some things that happened around when Saddam Hussein invaded Kuwait. We had major pumps in global fossil fuels, and then within a year they all dropped, and you look at US crude oil, stay down for 14 years, and Brent. I think that's going to happen sooner. The key thing I like to watch is also it's the global benchmark, for at least the US benchmark I watch, is US natural gas got to near 10 bucks per MMBTU. Now it's back to near 4. That's a long-term price. It's still well above the cost of production, but I think that's just human nature to trade the old trade. That spike is virtually never going to happen again, partly because now we've had time to prepare for it. And that's just usually the way commodities work. And that's the key thing I pointed out last year is this spike we had in commodities was historic. And if you look at it since the first big one in 73, then 79, and then each different one over time, they're usually at lower velocities. Now, this is pretty extreme. The key thing, it triggers recessions, it triggers demand and supply elasticity, but those forces are greater than ever. And you're seeing that in the US. We've had peak energy consumption, not energy, peak fossil fuel, peak liquid fuel consumption, and it's been dropping forever. The rest of the world's catching up, and higher prices are making that happen. So to me, what happened last year is never going to be repeated and certainly in a lifetime. And now I think commodities are going to be about where we're going to find bottoms. And the key point is there is a trajectory towards global recession. There's a trajectory towards demand destruction, and central banks are still tightening. So that's my point, is that trend should continue until we see massive liquidity pump in the system, and it's not happening nowhere near yet.
Okay, Mark, what about jet fuel? That's one of the products that's obviously, since COVID really, not had a chance to recover fully. And it's had its ups and downs since then. Outlook for that, given, obviously we've got the China factor, which is domestic travel more probably, but some international. But again, airlines, being quite bullish on their bookings, let's say. Obviously, they've hedged and bought jet fuel in advance. But where's that story? Is that going to stand out as a standalone, do you think?
It's going to be an interesting balance here because, yes, China is coming back, and demand in China, and if you're just looking at air passenger miles, as Victor was talking about, there's going to be a boost. But how much offset is there going to be? Because Europe is through its we haven't been able to travel in North America as well. We haven't been able to travel. Let's get out there. I want to go places. I think there's still definitely a spirit about, but households are under a lot of pressure. The housing market's coming down everywhere. It's not just China and the US. Europe's got plenty of examples of cratering housing markets. Australia, Canada, and New Zealand are a disaster area on that front. So it basically, the housing is a key element for a lot of people. So, I think the boost from China to air passenger miles is going to be to a certain extent offset by the pressure on households within Europe, within North America, within the dollar bloc, and so I think it's not quite as bullish as people are trying to make out, even though it is going to be of some significance and in a positive way.
Okay, Victor, let's talk a bit about the travel. I mean, we talked the New Year, the Chinese New Year is coming up, of course, and there's already been some forecasts on movement for that. I want to talk to you a little bit about what Mark just touched on, the housing sector. You've got the property sector issue in China, which has received some impetus and support from the government recently as part of its sort of boosting the economy drive. And give us a bit of a view on what the government's doing. We went from zero COVID to canceling zero COVID at the same time. Alibaba and Tencent and all these nice companies are kind of, the pressure is coming off them, in terms of sort of political pressure, let's say, or corporate pressure. A lot is happening in one go. So where do you see that from a government policy point of view? Is it again releasing the reins on some parts of the economy that it was coming down very hard on?
Well, as you can see from official data, the investment in the real estate industry dropped by 10% last year. And actually, the industry is kind of struggling. And some experts said earlier this year that if the Chinese people take out 1/3 of their savings to buy houses, they can save the real estate industry. But that's not what the Chinese people are doing yet, because they need to resume their confidence. And confidence, will take some time to be resumed. And Chinese people do not have much confidence in the real estate market for the moment yet. And for now, the prices are still too high. So most people would choose not to buy at the moment. And people believe the prices would go down. So the government is now trying to cut its dependence on the real estate industry for economic growth. So there will be some measures to stimulate people to buy houses, but not too strong measures, because it's trying to get away from this, while as motor of the economic development. Yes.
Yeah, and it's still going to continue to focus on this sort of new focus of service sector economy versus old economy. That's still sort of the trend. Mike, let's talk a bit about okay, well, let's look at our survey question, which just has been put up, which is are markets and corporates ignoring interest rate rise and debt burden lag effect? So a bit of what we were talking about earlier on in the conversation, this sort of exuberance that we've seen the last month, and we're seeing fourth quarter results, also corporate results still filtering out, still the tech sector still to come, I think this week or next week. Have we seen that sort of, I'm not going to take that to you, Mike, because you've already given me your answer on that. They are ignoring and it's all to come, but is there a lag effect? The real lag effect is still going to hit everybody.
Not even close. The first Federal Reserve hike was March of last year. It hasn't even been a year, and we've had the greatest velocity of hikes ever. And on a global basis, we've never had more central banks pull liquidity this fast ever. Typically, it takes about 18 months. Okay, maybe it's 12 months now. We've all mentioned housing. Housing's global, and it's the biggest pump then dump ever. This is classic historical economic cycles. And they always pump and then dump when liquidity is being taken away. So it's early days. It'd be wonderful if we get out of this. But I look at, then there's simple little indicators like the NASDAQ 200, it's at its 200-week moving average. It's only been there 3 times in history, and every single time the Fed was easing to save the market. Now it's still tightening. So yes, okay, it's one central bank, the largest bank in the world, but the largest importing economy in the world, and what's the largest exporting economy in the world is just opening up into a global recession. I like to say good luck with that one. Then I show all the cycles of commodities. I can go back 60 years. And this is just a normal pump that almost always they get cheap. And we're nowhere cheap at the moment. Now, lumber's one of them. That was the darling of the housing market. It's back below the price it was below before the COVID struck. I fully expect that to happen. Crude oil was $60 a barrel before we pumped this, before we hit COVID. I think it's going to go back there in WTI. Copper is probably going to come out of this ahead, partly because of what's happening in China and the switch to digitalization, electrification. But I come from a farm background. It's a lesson you learn about elasticity of supply and demand. Higher prices are the cure.
Okay, and what about the US dollar? Just stay with you, Mike, for a second. I'll go to Mark as well. The US dollar, has it reached its peak? Here's in the big picture macro, US dollar against a basket of securities, if you go back 50, 60, 100 years, always appreciates. Just give me maybe 1 or 2, it depreciates against, and that's just part of the way the system works. It's probably going to continue in the short term. We've had a pretty big pump, but overall the dollar is still going to have a bid below it, partly because it's the world reserve currency. It's strengthening. You can see that in cryptos. Cryptos are, yes, they're small, but it's the hottest market in the space, and most widely traded cryptos are dollar tokens, not Bitcoin and Ethereum. And then there's also the fact that the deepest market, deepest bond market, highest yields, and the protection. We see what happened with the war in Europe. Europe has protection on all its borders. So short term, it's really hard to measure, but overall, I'm still big picture. The dollar almost always appreciates versus a basket of currencies in the big picture. There's the survey result. Yes, 63%, 62% of our audience think that the lag effect is sort of being ignored. It's still to come. Mark, just on the currency front there, a lot of commentators saying that, the dollar is kind of more or less peaking for the time being, obviously versus other currencies. And has it been a surprise to see the pound and the euro sort of gained a bit of strength in this period when those economies exactly are under the most pressure?
Well, people say it's about economic outlooks. I actually say with foreign exchange markets, it's about interest rate differentials, and that it will remain that. It will always remain above all 10-year yield differentials. And the rallies that we've seen in European bonds and UK bonds relative to the US have actually been a lot smaller. So that gives some support to that. We haven't talked about the BOJ today, and if you look at what's happened with the yen this morning, that serves as a timely reminder that one of the factors that was driving down the dollar was people's speculation that the Bank of Japan was going to continue to carry on abandoning its ultra easy monetary policy. There was a very clear signal this morning that it's not. Well, at least certainly not until there's a new governor installed in April at the Bank of Japan. So, I tend to agree with Mike. At the moment, the demand for the dollar, yes, it's a lot less than it was. We're not getting the sort of squeeze. But I always say, if we're going into a global recession, that means global trade isn't going to be particularly great. In times of global trade basically being flat or contracting, basically the demand for the dollar strengthens. And when global trade is picking up, the dollar tends to go down for the simple reason that central banks around the world have a lot of excess foreign exchange reserves, which they recycle from dollars into other currencies. So I think the dollar is not as down and dirty as a lot of people would like to make out, but it has probably definitely put its peak in. And I think a lot of people are looking at those attractive yield differentials, particularly in the emerging markets that we're seeing. And, that's another factor giving some support to the idea that the dollar isn't going to perform as well this year as it did last.
Okay, Victor, talking about trade, Mark was mentioning there, and China, give us a perspective on, let's go a bit geopolitical. We've avoided geopolitics really so far this morning. China-US relations, we saw, a meeting at the end of last year and, a warming of conversation, let's say, between the two leaders. But of course, it's all got to do with the Russian stance as well, not just trade, but we've got your China-US trade tech crackdown, if you like, by the US on China. And then you've got the whole, how much is China aligning with Russia continuing now into this year? How is President Xi going to play this going forward this year? He's trying to boost his economy. He wants to probably have very good relations with the US on the economic trade front. Can he maintain his sort of neutral position on Russia?
Well, most people expected the US-China relationship to improve a little bit in 2023 after the meeting in December last year. And we expect that too, but the confrontation will continue and restriction from the United States. And what China is now trying to do is, well, as you said, maintain being neutral. And what for the country, what matters most is the economic growth. And it can trade with any partner, any country that is willing to trade with the country, and regardless of its government. So based on this, it can be the biggest partner with a lot of countries. But it's getting more and more difficult this year. So it will try to stay neutral. Yeah.
And what about its import we talked about its crude import outlook, but in terms of taking in Russian crude, and is it going to continue to take that in as long as it's available, as long as the discounts obviously prove to be an advantage? What's the outlook on that?
Yes, judging from the data for January, we see that imports from Russia actually increased, particularly in Shandong. And in most times, it depends a lot on the discount on Russian crude. But it will continue to import Russian goods despite the pressure from most parties. Yes, they will continue. The difference is, the share will go up or down for Russian crude. Yes, that's the only difference. Yeah.
Yeah, I mean, I think that pressure really is gone, hasn't it, Mark, from Europe? I mean, I think they've given up on pressuring people not to take Russian crude and just sort of hoping Russia won't be able to supply that. Just a very quick, as we wrap up, Mike, I want to go to you and Mark just to ask you about where you think. Some people are saying, that the ceiling that we're seeing now oil, in the early 80s now. Again, it's flipped up over 80. Mike, I know you're sort of medium-term bearish, but could we see the $100 before we go down again? Are we going to hit that?
We could. The enduring fact for crude oils, it's been in a bear market since 2008. It peaked 145, and this year got up to 130. That's a bear market. It had a good reason to go higher. I think it's more likely to find a cheap level around $40 or $50 a barrel in WTI. It might get to near 90 in WTI. I think there'll be more responsive sellers. And it's just a fact of what usually happens. I look at some of my charts. These are early days of corrections, and part of that is China. One thing we have to remember, and Victor might not be able to say, but the world's completely lost confidence in China because it's not China anymore. It's Mr. Z. And he did support the invasion with Russia. So the world is divesting away. It's certainly from an American standpoint. Everybody I speak to is trying every place they can to not import stuff from China anymore. But from a crude oil standpoint, I think 40 is more likely than 100. Or 50 is more likely 100, and it's more likely to stay down there. And just think of the fact, I'll end with this. We get to near 100, that adds to the restriction from central banks. It keeps central banks still pulling liquidity. That's a liquidity pull. It accelerates the trend towards global recession. This isn't new. It's the trend we are in right now, heading towards global recession.
Okay, Mark, do you think we'll hit $100 or so stay around this level as we have been for a few weeks?
We've probably got a little bit more upside. I think the thing which we probably haven't touched is the micro aspect. We are heading into an earnings recession, and that is what this US earnings recession is about. And people should always remember how closely correlated the S&P 500 is with the oil price. So at the moment, we're having one of those moments where things pick up. And then when that earnings recession, as we go through this earnings season, starts to really grate on people, we'll find the S&P going down as well as the oil price. And that's really, it's going to be bad news. And I completely agree with Mike. Markets are ignoring these rate hikes that we've got given the economic environment that we've got.
Okay, Victor, you raised your hand. I'll let you have. We've run out of time, but please,
Yes,
one more comment.
I would like to say something about what Mike said about his support. China supports the invasion. China doesn't support the invasion. What he did is he refused to condemn Russia for that. Yes.
Yeah, and China was not the only one which refused to condemn Russia. Let's remember. India being another one of those, and the two biggest consumers. So that makes some sense, perhaps. Okay, thanks very much until we run out of time. Thank you everyone for joining us and to our viewers as well. And have a great Wednesday. All the best.
Okay, thank you. Bye-bye.
Thank you.
Bye.
Bye-bye.